Did you know that most people who pay a professional to manage their money are actually losing? Today, we're going to dig into why that is and what the data says is a much smarter move. Okay, get this. This is the single most important fact to wrap your head around. Over the last 2 decades, a staggering 97% of professional fund managers in the US failed. They just failed to beat a simple market average. Let that sink in. So, in the next few minutes, we're going to break down exactly why this keeps happening, and more importantly, what it means for your money. All right, let's dive right into the hard data, because this isn't some fluke, The numbers are just crystal clear year after year. Take a look at this chart. It shows how all US stock funds have done. See all that red? Yeah, that basically represents failure. Over 20 years, nearly all of them, almost every single one, couldn't keep up with a basic market index. And you might think, well, that's probably just the small, risky funds, right? Nope. Even if you only look at funds that invest in the biggest, most well-known companies in America, the story is exactly the same. Over 95% of them still couldn't keep pace. And this isn't just a US thing either. When you look at international funds, guess what? Same story. Over 97% underperformed. The evidence is it's overwhelming. It's the same no matter where you look. So the big question is, why? Why is this failure so incredibly common? Well, it really boils down to 2 super simple reasons. It's all about how markets actually work. Okay, here's our first big idea. Before you even think about fees, investing is basically a zero-sum game. Think about it. All the investors together are the market. So if one person wins by $1, someone else has to lose by $1. It's just simple math. And this right here, this is the real kicker. This is our second big insight. Once you add in the costs, the management fees, the trading commissions, the whole average gets dragged down. It's not a zero-sum game anymore. It's a negative-sum game. This means the average person trying to beat the market is pretty much mathematically guaranteed to fail. Okay, let's make this real. Imagine 2 people, right? Both start with 100 grand. Both get the exact same 7% return each year. The only difference is the fee. One pays a pretty typical 1% for their active fund, and the other pays a teeny tiny 0.05% for a simple index fund. You ready for this? After 20 years, that tiny little difference in fees blows up into a massive $700,000 gap. Just wow. That is the price you pay for trying to beat the market. So, okay, if paying someone to actively manage your money is pretty much a losing game for most of us, what's the alternative? And this brings us to our third core idea. Index funds win because they don't even try to play that game. They're not trying to pick the next hot stock. Nope. They just buy a little piece of everything in a market index, like the S&P 500. Their only goal is to match the market's performance. And because they do that, their costs are incredibly low, which means you get to keep almost all of the market's growth. So the strategy seems pretty simple, right? Just own the whole market through low-cost index funds. But, and this is a big but, there's a really important warning you need to hear before you just assume you're going to get the amazing returns we've seen in the past. Look, this low-cost approach has been a huge winner. But is it a perfect solution? Is it a silver bullet? The data is telling us we probably need to dial back our expectations a bit. All right, here's our fourth insight. This chart shows something called the Shiller PE ratio. It's just a way to measure if the stock market is cheap or expensive over the long run. And as you can clearly see, we're way up there at historically high levels. The last 2 times we were this high, right before the dot-com crash and the big one in 1929. The pattern is pretty clear. When valuations get this high, they're usually followed by years of much lower returns. And it's not just one single metric screaming this at us. This chart is sometimes called the Buffett indicator, and it tells the same story. The stock market looks really expensive compared to the size of the whole economy. It just confirms the warning. What happened in the past? Well, it's not what's guaranteed to happen in the future. Okay, so what in the world are you supposed to do with all this information? What does it mean for your plan? It really just comes down to one key takeaway and one super simple action step. So here's the bottom line. Choosing low-cost index funds gives you the best possible chance of success. The math is on your side. But it's not a magic trick for guaranteed high returns. It's simply a strategy to get your fair share of whatever the market gives. You just have to be realistic about what that might be.
All right, here's one simple, practical thing you can do today, right now. Go look at one of your investment accounts. Find the fee you're paying, it's usually called the expense ratio, and just see what that number is. Knowing that number is the first step.
Subscribe for more clear, data-backed money videos.